get a bunch of people asking, around a preferred return. They think that it's an interest rate or a dividend or some sort of guaranteed distribution. And so I want to be very clear about what exactly a hurdle rate is or a preferred return. And what it ultimately does is it creates alignment between passive investor and the manager of the fund or the assets. And so at Lassiter Capital, myself and my brother, we invest directly into every one of our funds. So just like our investors, we put our capital into the fund, and that capital is treated the same as every other investor. So we're essentially an LP in the fund, and then we're a GP in the fund or the manager. And we do that for a couple of reasons. Number one, we like the deals that we do, and I want my money working for me just as each of you do as well. But number two is alignment. Many operators or managers don't invest directly in the funds that they have. They may invest in the project, but they do it separately and their money gets preferential treatment. And ours, we want that working alongside all of our investors. And it allows me, puts me and my brother into a mindset so that we can think from an investor's perspective as well as from the manager's perspective. And then we can look at the big picture when we're making decisions on how any decision impacts both of those aspects of the investment or both partners ultimately involved in the investment. And so, really, then a preferred return is another tool added to that to create alignment. What I mean by that is a preferred return. I'm gonna break it down. It's often uh, said as a pref rate or a hurdle rate, and I think hurdle rate best describes it. It's a hurdle or a benchmark that the fund has to produce to the investors before the manager starts earning income. And what I mean by that is I'm going to use our current fund as an example. So we have multiple classes in our fund, depending on what an investor comes in at. Depending on how much capital they invest in the fund, puts them in different classes. And one of the classes, we have a class that's reserved for our institutional investors, $5 million plus. Okay. And so at that class, when one of the institutional investors or extremely high net worth investors comes into our fund at $5 million or more, they get a 14% hurdle. So, and then a 90-10 split of profits. So their preferred return is set at 14%. And what that means is they on the money, let's say they invested $10 million. Okay. So on that $10 million, they are owed $1.4 million or 14% per year before we get any split of profits. Okay. And so the way that works, typically when we buy assets, they're definitely not going to cash flow at 14% from the onset. And they may not ever cash flow at 14%. I've had some that cash flowed as high as 12, almost 13%, like 12.7. Okay. It's not typical. Typical is in the first year, 2 to 4% while you're doing value add. And then it grows from there. You'll see 4 to 6 maybe in the second year, 6 to 8 in the third year. And that's kind of where it hits and caps for the life of the investment. Okay. And so with the hurdle rate, an investor that invested $10 million that's owed $1.4 million before we see profits, well, in that first year, they may get $200,000. Okay. That means they're still owed $1.2 million from that first year before we get to participate in the profit split, that 90-10 profit split. Okay. So moving into year two, they get $600,000. So they're still owed 1.2 from the first year, and now they're owed 800,000 from the second year. Okay. And so then let's say for ease of math, years 3 through 5, it did cash flow at 14%. So 1.4 million. Okay. They're owed 1.2 and 800. So they're owed $2 million from years 1 and 2 at the sell of the asset. Okay. So when we sell the asset, they'll then recognize that additional $2 million of cash flow from years 1 and 2 that they didn't get. Then they'll get their $10 million back. Okay. So now they've gotten their capital back, their $10 million. And this holds true as well with a refinance, which is typically how we're looking to exit an asset. Instead of fully selling the asset, we want to refinance the asset so that we maintain cash flow, but we get our capital back out. Okay. So now they've gotten their capital out. They've gotten $1.4 million per year. And then everything over and above that is split 90% to the investor and 10% to us. So that preferred return or hurdle rate creates a working relationship, and it creates a incentive for the operator to execute upon in order for them to earn out and start earning income. Okay. So if for example, an investment doesn't hit the preferred return, okay, let's say that for some reason the investment, I'll use the last 3 years as an example. The last 3 years where we've had an extremely tough economy, where we've had interest rates climbing exuberantly, it eats into the profits. Okay. And so then you're going to have investments that may not meet the preferred return. They may meet, let's say the preferred return was 10% and they only hit 8% per year. Okay. That means the investor is going to get their money back and they're going to get 8% per year. And the manager isn't going to get any earnings in that example. Okay. And so it creates a working relationship with an incentive built in. Okay. And so that's exactly what the hurdle or the preferred return is meant to do.